On one hand, we're told that we have a record household debt. On the other hand, apparently we also have the highest savings rate we've ever seen. We're also told we're going to see the biggest interest rate hikes in the coming months, yet we're likely in a recession right now. Are you confused yet? In this video, I'm going to try to untangle all the contradictory information and try to give you my prediction in terms of what's going to happen in the short term over the next few months. Hi, my name is Vas. I'm a chartered professional accountant turned realtor that's built and invested in real estate right here in Toronto, York region, and in secondary markets outside of the GTA. Whatever prediction I make right now, I'm going to hold myself accountable to. In 4 to 5 months, I'm going to revive this exact same video and we're going to look at why I was wrong, because most likely I will be wrong, and if I was right, it will likely be for unrelated reasons that I'm going to talk about now. If you have high conviction in terms of what you think is going to happen over the next 5 to 6 months, please comment below. When I review this video in 5 to 6 months, I will be looking at the comments as well to see who was right and who was wrong. Let's have fun with this. Let's talk about one of the key factors why prices dropped as fast as they did in the last little bit. So number one, we had motivated sellers. We had people that had purchased properties in February and March that had to sell their current homes and were willing to take whatever price was necessary in order to close and close fast so that they could close on their purchases. I personally experienced this with my own clients and listings I recently had. I have to say it was a tough 6 to 8 weeks for anybody that got caught into this crazy market that we just had, where buyers effectively got sucked out of the market for about 4 weeks. And then they slowly started trickling back in and actually making offers and purchasing properties at severe discounts. So at this point in May, unless you're paying 80% or less of what the peak price was in February or March for the most of the GTA, you're likely overpaying. Now, the good thing is that most motivated sellers are almost out of the market. We might have a few stragglers still holding out, but for the most part, majority are out. And now whatever listings are coming on the market, it's usually people testing the waters. They haven't bought, they're not in a rush, and they're likely to terminate if they don't get what they want. Number two, it's interest rates. So there was an article in the Globe and Mail that I found actually funny, where potentially interest rate hikes may be put on pause because of what it's doing to the housing market, meaning referencing the housing decline in prices that we've seen, as well as transaction in the last 2 months. Typically, stock market losses will make their way into real estate. They always do. It's just a little bit lagging. The last point is on inflation, specifically gasoline, food, everything that we buy on a daily basis, and that is having a direct impact on our pocketbooks right now. I think this is the most critical factor that's driving decision making for the average consumer right now. And early data out of the United States is already showing that we're creating a credit risk bubble where people are taking on credit to subsidize the lifestyles that they were used to having during COVID, where we did not have the inflation that we currently have. I'm going to play you a little clip from somebody. His name is David Friedberg. He's one of the early Google employees. This guy has his hand on the pulse of the economy. Somebody I respect. He's made a bunch of predictions over the last 12 to 18 months, and he has been fairly accurate.
But I will tell you, I'll say this one more time because I think it's so important, and it's my kind of prediction of the week. I really think we're going to run into a consumer credit bubble here. I do not think that consumers are going to slow down their spending or change their lifestyle as quickly as investors are changing their investing style. We have seen investors in public markets and private markets take massive corrective hits this week and last week, and they're changing their behavior in some of the stories we shared today. But consumers are taking on more credit. They're opening credit cards, they're taking out bigger loans. Prices are going up 10% year over year for them. And so the concern is if we actually do hit a recession and we don't see real wage growth and the consumer credit bubble continues to grow, we're going to face a credit crisis in, call it 9 months to a year, where we're all going to wake up and be like, wait a second, how are consumers going to be able to afford all this credit?
As mentioned in prior videos, let's talk about one of my favorite Twitter accounts by Ivan Gorbaday here. He releases mid-month stats with projections in terms of where the market is trending. I find this very useful. If you don't follow him, please do. Solid information. Now, we're going to look at 7 of his slides, and I'm going to give you some of my perspective on what I'm seeing here. So Greater Toronto Area, all homes active listings are going up. We're still below 2019 and 2018 levels, but we are starting to creep up to where we would be seasonally for this time of the year. When we get into the condo apartments, active listings are creeping up right now above seasonal average. Now, I can tell you anecdotally from my own experience, over the last few months, a lot of investors try to take advantage of the market that we saw in Feb and March, and they try to get their tenants out and they try to list their units to see if they can get those peak prices. I can tell you because they didn't act fast enough, or they weren't prepared, or it took a long time to get the tenants out to list the units. A lot of them ended up listing, and now they're not getting the prices they thought they could get, so they're terminating the listings and releasing those apartments. You're not going to see it in these stats yet, but that is something that's happening. I have dozens of anecdotes of this exact same thing happening. Looking at prices, again, we're seeing a slight decrease in pricing month over month. I think this is going to stabilize over the summer, potentially dip another 5%. I don't think we're going to keep going much lower than where we are right now. We might hit back 2021 numbers, 2021 summer numbers right here, but I don't think we're going to go much lower than that. It is still the cheapest asset class, and now employers calling employees back to work. The downtown core is reviving. The path is busy. The surprising thing here is Toronto detached is actually faring fairly well. There are certain areas of the city that are holding up, and this is also a composition issue, I believe. I think a lot of high-end, more expensive properties are selling. It will be interesting to see where this goes. I don't see Toronto dropping much. Good old Durham. So Durham was, like I've said in prior videos, the darling of COVID. I mean, if you owned in Pickering, Ajax, Whitby, Brooklyn, Oshawa, even Bowmanville and Coburg, it was effectively like winning the lottery. You were up at least 100% on your property since 2019, give or take. And now we're seeing the unwind of that. And honestly, I don't see this stopping anytime soon. Potentially, we're going to see this kind of taper off, but I think long term, these will continue to bleed out and continue to drop in price. I don't know up until what point, but if I was a buyer in these areas, I'd be very careful what I'm getting myself into right now. York region is starting to stabilize. We saw massive drops here in price. York region, for the most part, has stopped bleeding. And I think at this point, people are going to hold out. They're not going to sell. Anybody that's listing now is just testing the waters. Nobody's in a rush to sell, is from what I can see. So I feel York region is going to stabilize and probably remain in and around 2021 numbers averaged out. Let's talk predictions. So I think condos in general are going to do well. If we have a recession, if things do get worse, I still think condos, relative to everything else, are going to outperform. They were the worst performers during COVID, and this is why I think they have the least amount of downside risk relative to everything else. For example, if I was a buyer right now and I was buying a condo, I wouldn't be as nervous if I was a buyer in Durham or Brampton or North York region, as an example. If you're a buyer in York region, I think it's a hit or miss. I still think we have some unwinding to do of gains, but we are seeing a price floor being set in York region in places like Markham, Aurora, Richmond Hill. In general, I'm seeing a reversion back to some sort of a fundamental normal market where distance, commuting, all of these things start to matter. And with external factors like price to commute, all of these things are now becoming relevant as people are going back to work. So with that being said, my prediction is condos will be the best performers over the next 5 to 6 months. Detached in Toronto still has some ways to go in terms of price declines, I feel, but for the most part, I think it will be within 5%. For York region, I think that number is probably up to another 10% potentially, ideally 5%. For Durham, I think the unwind is more. It's likely we're looking at double-digit declines, and I don't feel the unwind of pricing in Durham is done. Same for parts of Peel and North York regions such as Newmarket, Keswick, East Gwillimbury. If you're thinking about buying or selling in this market, if you're in York region, Durham, or Toronto, give me a call, text me, or email me. I'll help you strategize what I think you should do. And maybe you're not even ready to sell. Maybe this is not the time to sell. Maybe you need to hold off. But if you need a second opinion, give me a call, and I'd be more than happy to chat and give you my thoughts on what you should do based on what I'm seeing in the market right now. Thank you.